Hey everyone, it's Brian Bogner here. Just want to take the next few minutes and talk a little bit about the recent volatility that we've been experiencing here in the stock market. I'm sure you've read the news, you've seen what the media is reporting. It's gloom and doom, which is no surprise. That's what the media does. Today, I just want to take a few minutes and try to give you a little perspective on what's going on right now. Okay, this is the S&P 500 going back about 6 years. And as you can see here, it's measuring the magnitude of each move over the last 6 years. Well, as you can see, there have been numerous corrections. 9%, 17, 21, 10, 11, 9, 7.5, 6. Back in October, almost 10%. This current correction, we're down 7.67%, okay? So, if you're an investor and panicked through any of these and pulled your money out, you would have missed a significant move in the market. And at this point, we believe that this is just a correction. Now, I'm not saying that it is just going to stay here at 7.67. It could go to 10. It could go to 15. There could be some more downside. But at this point, we're the belief this is simply a correction. This is not some major market top and we're on the cliff, edge of the abyss about ready to go over. And I'll show you a couple of reasons why we believe that is the case, okay? Historically, there have been 90 corrections since 1928 of 10% plus moves down, okay? Which, if you average that out, every 11 months, there's typically a correction greater than 10%. Our last greater than 10% correction was 3 years ago. Well, technically, yes, it was back in 2012. However, back almost a year ago in October, we had a correction of 9.84%. So almost 10, but technically not 10. So my point is, these happen all the time. Not only do they happen, if you notice, corrections usually happen fast and furious. Markets take their time, they kind of grind higher, they correct quickly. Grind higher, move down quickly. Again, and that's exactly what we're experiencing now. This is nothing new. This is nothing different than what happens a lot in the market, okay? A couple positives that we see right now. This is the S&P 500, stocks above their 50-day moving average. This is a breadth indicator. It just helps us see the health of the market. And as you can see, this number has been trending down here as the market's been kind of moving flat here this year. Well, we are starting to reach some extreme points when it gets down to about 100 names that are only 100 are above the 50-day moving average. These have been some short-term bottoms here in the market. And sure enough, we're getting near that point. So not only from a breadth standpoint, but from a sentiment standpoint. This is the put-to-call ratio that measures investor sentiment. And when this number's high, investors are bearish, meaning they're doing a lot more put contracts than call contracts. When the number's low, they tend to be bullish. Well, over the last 6 years, we're actually at a point now we've never seen in terms of the bearishness of investors. So this tends to be a positive because when investors are all bearish, usually you're getting near a bottom. When everyone's bullish, you're usually getting near some type of top. We've been saying for a while now that the stock market is a bit of function of Fed activity. This blue line is the assets on the Fed balance sheet. Sure enough, when they're increasing their balance sheet, the market's been going up just nicely. When they move sideways here, that's when we've seen some corrections. Guess what? This is no exception. What does have us concerned right now are yield spreads. So when we look at corporate bonds, which is this yellow line, and compare their yields to a 10-year treasury, okay, that's what this line here is plotting down here, is just the difference between these two. What we're seeing is that spreads are actually expanding right now. When spreads are contracting, this is positive because people are embracing risk, they're buying riskier assets, they're moving their money into riskier things, very positive. When these spreads move up, people are selling riskier things and moving their money into safer things like treasuries. We moved up some last year, pulled back a little bit this year. Now spreads are starting to expand again. If this continues, this will give us some concern. So we are going to monitor this very closely. Another reason why we don't believe this is a major market top here is that the last two tops that we've had The Fed has been aggressively raising rates, trying to slow the economy, slow things down going into these tops. You saw that in 2000. You saw that in 2007. Guess what? Where you are, Fed's got Fed funds rate is basically at 0% right now. So we're not seeing the Fed aggressively raise rates. So some of the things that we look at the criteria here in the recent history of major market tops, we're just not seeing it. Also, in these two instances, shorter term interest rates were higher than long term interest rates. That's certainly not the case. You have a nice steep yield curve right now, which banks do well. A lot of companies, industries do well when you have that. So in summary, breadth and sentiment are reaching extremes. So we may not be there, but we're certainly getting close to some type of short-term bottom in here. 10% plus corrections happen quite frequently. We're only at 7.6 right now. Bond yield spreads are more telling in the stock market. That's what we're watching a little more. Interest rates are still low. Yield curve is still steep. Another thing too, think about 2000. We had a tech bubble, fraudulent earnings, a lot of fundamental things that were wrong with the stock market and with the economy. Same thing 2007. Credit markets completely froze up. Housing crash. All kinds of excesses going on there that just blew up. 2015, we look around, we're not seeing a lot of these things that are just, huge red flags in the economy. We're not seeing them yet at this point. So we don't believe that this is a market top. We just think this is a correction. And quite honestly, we do think it probably has a little bit more to run. In the portfolios, we have over the past couple months raised cash. We've been posturing ourselves a bit defensively. Our hope is we do see a bit of a correction here. We're able to deploy some of that cash back into the market at some lower prices. So if you have any questions, please call us, please email us, please contact us if you have any concerns or worries out there. We're happy to talk with you, happy to go into more detail with this. Thanks again for your time today, and we'll talk to you later. Have a great day.